Hello, everyone. Welcome back to the Market Navigator series. Today, I want to challenge a narrative you've probably seen making the rounds. The S&P 500 is trading above 20 times earnings, and that's way above the historical average of 15 times. So markets must be overvalued, right? That logic sounds simple, but as investors, we know better than to stop at surface level analysis. In this episode, I want to walk you through why this comparison falls short and how the market has evolved in ways that make these long-term averages less useful than they used to be. Let's start here. When people say the long-term average PE is around 15, they're right. But think about what kind of companies were dominating the S&P 500 when that average was taking shape. Back then, the index was led by industrials, energy, materials, and utilities. These were capital-heavy cyclical businesses. Their margins were tight, their earnings volatile, and they were deeply tied to the interest rate and commodity cycles. So naturally, those businesses traded at lower multiples. A PE of 8 to 12 was normal. Now let's fast forward. Today, the S&P 500 is dominated by technology, communication services, and healthcare. These are high-margin, asset-light, innovation-driven businesses. They scale globally. They generate massive free cash flow, and they aren't as tied to economic cycles in the same way. We ran the numbers. If you take the long-term average PE of each sector and apply it to the index composition in 1980 versus today, you get two very different results. Even if every sector were trading at fair value, today's market would still have a higher average PE, simply because of what it's made of. So is a market expensive? Maybe in places, but let's not pretend 15 times is some universal benchmark that applies equally across time. The structure matters. Let me say this another way. You're not paying more for the same product, you're paying more for something that's fundamentally stronger. Take a company like Apple, for example. You're talking about a company with more cash than the Federal Reserve, global reach, recurring revenue, and fortress margins. Of course, investors can make the case that that deserves a higher multiple than a cyclical steel or oil company from the 1980s. Now, this isn't about defending higher prices. It's about understanding what the price actually reflects and if we should be comfortable paying it. So, where does this leave us? It means using static long-term valuation averages to judge today's market is like using a map from 1975 to drive across a city in 2025. Some roads are the same, most aren't, and some roads now didn't even exist back then. Saying we're in a bubble just because PE ratios are higher than the 40-year average is one-dimensional. The index is more tech-driven, more cash-rich, and less economically sensitive than ever before. That does not mean markets can't go through corrections. They can, and they will. But it does mean that we need to ask better questions than, is this above or below the average? Instead, we should be asking, what are we buying? How resilient is the business model? And does the price reflect that? If this helps you rethink what valuation really means in today's market, feel free to share it with others. And as always, if you want to talk through your own portfolio positioning in light of all this, let us know. We're here to help you navigate it with clarity and confidence.